Welcome back. Looking for hope in housing. Homebuilder stocks averaging returns greater than the S&P 500 over the last 6 months. This despite negative headlines. But will the market continue to outperform as the Fed, which is watching for a cooling housing market, keeps its foot on the brake? Joining us now for more, John Lovallo, U.S. Homebuilders and Building Products Equity Research Analyst at UBS. Thank you for joining us here today. First, your big picture assessment of the industry in a year that has been rocked by interest rate volatility.
It's been a wild ride for sure. I mean, we launched coverage in January. The stocks were down 20% at the time, and they continue to go down a lot further, as you know. Interestingly, as you alluded to when we opened, since November, which is the start of this sort of seasonal hope trade, stocks are up about 13% versus the S&P up about called one-ish percent. If you go back to when the stocks sort of troughed in June, they're up about 30% versus the S&P up about mid-single digits. So they've really rocketed back pretty sharply. And I think it's really a function of the market finding a bottom. I think we hit the bottom for new home sales in July at about 543,000. And I think that, we're going to slowly get better and better here. Now, it's going to be a tough ride. Interest rates are going up, as you mentioned. The Fed is content on raising rates and really kind of stifling inflation. So it's going to be challenging. We think that new home sales and housing starts will be down next year, but it's a much different story for the stocks, which are already discounting a lot of this bad news, in our opinion.
This is a really interesting thesis, John, because certainly it doesn't, for lack of a better word, it doesn't feel good, right? What's going on in the housing market, right? And it feels like it's going to be kind of rocky for a while. I mean, we got some numbers on pricing this morning, and it seems like there's definitely the supply-demand situation is still very much not in balance.
I think it's a great point, Julie. Look, I mean, I would argue that the supply-demand imbalance is very much out of whack in the sense that if you go back to the global financial crisis, we were underbuilt by, call it, 3 to 4 million units. Now, things have slowed for sure over, the past 3 or 4 months, given what's happened with the Fed. But we think that, that underlying demand is still there. And it's very evident when you see things like rates pull back, 40 to 50 basis points. And November new home sales are at 640,000, which is a really good number. But you're right, the data is mixed. Housing sentiment is not good. Housing starts were lighter than expected. The home prices were a little bit softer than we expect. I think what's interesting, though, the bear case is really assuming that home prices crack and go down, in the neighborhood of 20 to 30%, similar to what we saw during the global financial crisis. We think that, supply is way too tight and underlying demand is still much too stable for that to happen.
Could we delve into that a little bit more? You've mentioned the global financial crisis a couple times here. Just what are some of the key differences? I would note one is probably you don't have the massive retail speculation in properties the way we did 12 years ago or 14 years ago leading up to that. But maybe some of the secular demographic tailwinds that we have from millennials and Gen Zs trying to find homes with burgeoning families. Could you speak to some of those as well?
Yeah, I think that's right, Jared. Look, I mean, there's a strong wave of millennials coming through the pike that are reaching prime home buying age, call it between 30 and 35 years old. That is really strong underlying support. This first-time buyer is very need-driven, need-based, if you will, where if they can buy a home, they will. If that means moving a little further out from the city or buying a smaller footprint or borrowing money from mom and dad, they'll do it. So I think that, there's a very strong underlying sort of core demand element. And then on top of that, as you mentioned, the differences between the global financial crisis, there were 10 months of supply of inventory on the ground during the global financial crisis. There's 3 months today. That's and put it for context, the average is about 6 months. So we're way too low on the supply side. And I think on top of that, you have just this element of, more mortgages were kind of issued during the global financial crisis that were floating rate mortgages that adjusted very quickly, call it in a year or two, which resulted in a lot of foreclosures and a lot of more supply coming onto the market. So it's a much different ballgame today than it was back then.
John, are you recommending to investors that the home builders in general should be bought, or do you think some are better positioned than others?
Yeah, good question. I mean, I think I would love to tell you that there's differentiation right now, but unfortunately there's not. I think the group is trading, very much as sort of one stock, if you will. So I think right now you're probably best served buying the biggest and the best, most liquid stocks. That would be the DR Hortons of the world, Lennars of the world. I think that you'll be well served playing those names. However, I think as the recovery continues, then there will be some nuance, and it'll be an opportunity to be a little bit more selective. But right now, I think, even playing the index is probably a fair way to think about things right now.
Well, we'll catch up with you in a bit then and see how it all plays out. John Lovallo, U.S. Homebuilders and Building Products Equity Research Analyst at UBS. Thanks, John.